Hi everyone, and now we are going to look at the intraday trade opportunities that we get and we analyze on the altcoins, right? So, as one of the best trading principles that you will ever understand is about liquidity and its grab and inducement. So, if you look at the price structure, the market was moving towards this area of interest, and first of all, we need to identify the direction of the market. Once after, look, the market has taken out this liquidity and the market is forming a lower highs. Again, market is forming a lower high. The market has broke down this structure, came back, filled and hunted down this liquidity. So the market is bearish, right? The market structure is bearish and the market has taken down this liquidity. Now, after taking down this liquidity, the market will try to take the liquidity or to take the stop losses of all the short sellers. So one of the setups that we have learned here is let the market, let the price come back and take the liquidity at this lower high. The market came, break of structure happened, took down this liquidity again, and at this fair value gap, look, it started creating a higher lows. At this fair value gap, we create a buy position and we look for this liquidity. So we create a position, we keep a stop loss at the low of this higher low and we look for the liquidity grab of this. So we get a 1:4 risk reward. It is a very high probability setup. And then again, look, when the market has taken out these liquidities of the short sellers, now there is another wonderful short opportunity here. If you see, these are intraday trades basically executed on 15 minutes. So here the buy side liquidity has been taken out, right? The price failed to push past towards this and thus a short position was created at here and targeting this liquidity zone. So it gave us a 1:3.9 risk reward trade. So these are the trades where you will find 1:2.9, 1:3.9, 1:4 risk reward, and these are the setups which are present almost every day in the market. These are the setups based on market structures and liquidity. So we have understood this ADA. Yeah. Now we are now going to look for Doge. So if you see, the same structure and the principle is followed in Doge. The market is creating a lower high. Market is creating a lower high. Yeah. And market has created a area of interest and a liquidity pool here. So the price came back, breakdown happened here. Price hunted this liquidity down. It took the buy side liquidity. It stopped out the fresh buyers here, and now the price came back at this. Now you can create a position at this fair value gap, you can create a position at this fair value gap, or you can create a position at the break of this structure that has happened and the retest at this section. So the best possible way to trade this here is first create your position and keep a stop loss at the end of this low and target this buy side liquidity. So we have got a 1:7 risk reward. This is a very high probability trade, and once we are in a winning position, we need to keep adding to our position, right? So we keep adding to a position. Now you see the market has given a breakout, right? Market has created a breakout and the price came back to fill this bullish order block. We entered long position again here with our stops at the low of this lower high and again. So if you look at it, we got a combined of 7 hour, 5 hour, total 15-hour trade on this positions. It was a beautiful intraday trade. And now what happened? Look, another setup is presented here. All the buy side liquidity, all the short sellers liquidity have been traded, right? And now it has created a bearish area of interest. Now we are looking for if this price is able to get past this again. No, it is not. It failed to go past beyond this and it created a lower high, right? So now we are going to look for another short position here, and we'll keep our stop loss above this, and we will target this breakout zone, right, where the breakout has happened. We got another 3R. Now this is how we trade on intraday trades. This is very simple. You don't have to need to have uh, very long biases of markets. You don't need to have a very high time frame analysis. You just need to understand where the market is heading, where the liquidity inducement is going to happen, where the price has taken previous liquidity, and then you need to keep your entries at fair value gaps and bullish order blocks if you're going for bullish entries. And if you are going for bearish entries, you need to look where buy side liquidity or the shorts, so short sellers liquidity has been grabbed and the price starts reversing, so you take a position at that. So these are very high probability setups. And now let's look at XRP. So these move this big move that you are seeing here, this is a news oriented move and it is very difficult to catch. This is a move when SEC has dropped its allegations on XRP, so the market rejoiced on the move. It is very difficult to capture, right? But one of the setups that you need to understand is, look at this area of interest. It has taken away this liquidity, right? It has taken away this liquidity. The price failed to break above that, and at the third retest we are going to build a short position at this area of interest with our stop loss above this candle high, and we're looking for the price to take down this liquidity, right? Look, we got a 1:3 R risk reward rate. Now this position, this setup, if you remember from a previous analysis of Doge and ADA, that if the price comes back here and if the price take down this buy side liquidity, we are again going to form a bullish position here, and we will look for this liquidity, right? We will look to target this buy side liquidity. The same concepts happen here in BNB. The same things keep on repeating. If you look at the fundamentals, if you look at the basics, the market moves on the basis of liquidity. The market moves where there is next pool of orders, where there is next move likely to happen, right? If you look at the same trades, break of structure happened, price came back, retested, took away this liquidity, came back, created a fair value gap, price came back to the fair value gap, we kept the low of this candle as our stop loss, and then we are going to target this liquidity right here. We have targeted this and we have got 1:6 hour trade. Beautiful trade. So this is how we target and trade on intraday on the basis of ICT concepts, SMCs, SMTs. If you look here, it is also creating a smart money divergence. If you look at it, and this is an advanced topic, I'll explain you probably next time. But if you understand the basis of liquidity, order blocks, fair value gaps, and you understand price action, basic price action, where there is a demand area, where there is an area of interest, you will find setups that keep repeating itself. Thank you.